All right, so today we're going to be covering how to take more control of your 401k plan utilizing do your own models. My name is Alex Perney. I've been with Advanta since 2012. I kind of got my start in operations doing investments for clients and helping clients structure different investments and the like. I was involved in over 1,200 different investments for clients while I was in my operational role, and now I've moved over to helping clients understand the benefits of using self-direction and my role in business development. So if you have any questions on that, I can certainly help to use some of my knowledge operationally and on the business development side to help answer those questions. My direct contact information is right there on your screen, so please feel free to give me a call or shoot me an email at any time. I am always happy to help out with those questions. And speaking of questions, make sure that if you do have any, since you are muted on today's presentation, that you do type those in to the chat box, and I will address those as they come up. Quick disclaimer before we get started: Advanta IRA and our employees do not provide investment advice or endorse any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So a few takeaway points that I want people to leave with here today are that IRAs and former employer plans qualify to fund a new 401k plan. With the exception of a Roth IRA, you can roll any type of IRA or former employer plan into a new solo 401k, whether that is a do-your-own model or a more full-service one that we administer. You get to choose the administration model of the 401k plan. You're not necessarily locked into only doing one type. There are a lot of different options when it comes to how you actually administrate these types of plans, which will ultimately determine how much flexibility and how much responsibility that you have on your side for the plan itself. And then another thing is that all expenses related to any type of investment done through a 401k have to be borne by that 401k plan directly. You are not able to pay anything personally with regard to the plan investment expenses, and then any income that's derived from any type of investment in a 401k is ultimately going to be deposited back to that 401k plan as well. So what is an employer-sponsored plan? Now today we're specifically going to be covering 401k employer-sponsored plans. Now, a lot of people are into some type of misconceptions that anyone can have a solo 401k plan. I had a conversation with some people earlier this week that wanted to use one, but weren't necessarily able to do so because they didn't have self-employed business activity or income. Now, keep in mind that with a 401k plan, it has to be attached to some type of business activity. If you're a W-2 employee and you make ordinary income and don't have any type of side business or self-employed business that would qualify income to be attached to a 401k plan, unfortunately, you can't just necessarily open a solo 401k plan. But with that said, it's just important to understand that these plans are specific in the fact that they have to be attached to some type of business. And the ultimate goal of that is to help the employees and their employers be more financially independent and help retain employees. Now, obviously, that can boil down specifically to solo 401ks. It really is more to the fact of helping you be more financially independent while you don't have a larger corporation to sponsor a 401k plan, allowing for you as the individual to have this type of plan. Now, although this may be something that is a little bit new to most people, the ability to do your own 401k or to have a solo 401k has been around for many years. Since 1974, you have been able to have these types of plans. It's just that they always haven't been marketed, and larger firms haven't really kind of specialized in the smaller aspects of these, aiming towards the self-employed crowd. So just understand that this isn't inherently anything new or exotic that you're waiting to see some more legislation on. These things have been well ingrained in our in our internal revenue code for many, many years. I did see that someone had their hand up. If you do have a question, please make sure that you do type those into the chat box if you do have any questions. So here's a few components of the 401k plan. As I mentioned, you do have to have some type of business that is attached to this. So the sponsoring business. Now, this can be a self-employed business activity. It doesn't have to be something as formal as a larger LLC or partnership or anything like that. It can simply be self-employed income. It can be subchapter S filing income that does qualify you for this type of retirement plan. So the entity that creates the plan for the benefit of their employees is the sponsoring business. It can be an LLC, it can be a C Corp, a sole proprietorship, et cetera. It can definitely boil down to the individual, the self-employed individual. So just because you don't have employees doesn't mean that you're necessarily out of luck. This really is designed, what we're going to cover today, for the self-employed individual. Now, when we talk about the employee versus employer contributions, keep in mind that we're referring to you as the individual. But on a broader context, the other part of a 401k plan are the participants of that plan. And an eligible employee, in this case being you as the sole proprietor or sole employee of the business, does allow for you to fully participate in that plan. And then under some plans, not all employees would be able to qualify. We're not going to get too far into that, but just in understanding the different parts, you have to have the business, the employees or the participants of it, and then you also have the contributions. With 401ks, there's two specific types of contributions. There's one that comes from the compensation that you're paid, so what you electively defer out of your paycheck. Now, with a self-employed individual, especially if you're filing on something like a subchapter S where everything is passed through to you, you're going to be using more of a total compensation number with regards to the specific amount that you defer, and then the remaining portion that you've deferred and taken as a deduction. Then you can also have an employer contribution that is a ratio of how much money that you've actually made can be contributed into that plan as well. Hi. Okay, so we got a couple of questions. So with regard to what I initially had said, Robert, so my role in operations was assisting clients in the investments that they were doing. So not necessarily advising them on that. Everything that is done here at Advanta is self-directed in nature. So if a client brought us an investment, we would work with them to make sure that it was properly vested and then ultimately pursued within that plan or account type. We were never giving investment advice, and neither was I. It was more of an operational involvement of making sure that things were structured correctly for them actually to be pursued by an IRA. There's actually no investment advice being given in that scenario. Okay, let's see. Bijou asks, I have a job and on a W-2 have a 401k, but I'm not taking payroll from the LLCs and S Corp. I still have a SEP IRA as long as the totals of the 401k SEP not out of 57. Let me read that again one moment. Bijou, I'm sorry, I can't quite decipher with that. If you can maybe rephrase that, I'm happy to address that question with regard to being covered by multiple retirement plans. So yeah, so the last part, contribution. So you have to have a sponsoring business, you have to have people participating in the plan, which can certainly be you as the sole business owner, and then contributions of the plan as well. So these three parts are going to make up the primary components of the 401k plan that you might be looking to establish. Okay. So with 401k plans, with us here at Advanta, you have two primary options. You can either do your own, or you can have a more full service model of the solo 401k. So that's, again, what we're going to primarily be focused on. Now, both of these two types of models are going to use the same type of components that we talked about previously. So the sponsoring business, the employees, and the contributions. So you're not getting away from one of those three parts. You still have to have them for the plan, but just keep in mind that we're going to be getting in a moment to how the two different types of models, whether it be full service or do your own model, is going to affect you as the business owner and the plan sponsor. So for year 2021, just want to put up a few contribution limits for everyone to understand what we're looking at. We're just going to skip down to the 401ks here. So if you are looking at how much money you can put into a 401k per year, you have an initial $19,500 of funds that you can take out of your paycheck, your take-home pay. It's what's called your elective deferral, and if you are over the age of 65, you have an additional $6,500 you can contribute to that plan per year. Now, this portion of your 401k plan contribution is called the employee contribution or elective deferral, meaning you are deferring a portion of your direct take-home pay to the plan. Now, this part of the 401k contribution can either be deductible or non-deductible, meaning it can be either Roth or traditional. Now, you can also contribute on behalf of the business. Now, depending on how you actually file your taxes, that can be, a much different number when you're looking at it, depending on whether or not you segregate your revenues or if you just pass it all through as one lump sum to yourself personally. But if you pass it all into one lump sum personally, you need to take that total number or your net operating income that's paid to you as in that scenario, and you can contribute up to 25% of that, not to exceed $35,000. So you can potentially have either $57,000 or $6,500 in these plans per year in total, depending on if you have the ratios to max those out. Let's see, Bill asked, is the 25% employer match added to your adjusted gross income? So that is going to be a deductible contribution to the plan. Now, depending on how you're filing your taxes, if you're filing as a C Corp, obviously that is going to be a full corporate deduction. But if you're filing something that passes on your deductions to you personally, that would then in turn help to reduce the amount of adjusted gross income that an individual is showing per year. So the elective deferral and the employer match can both help to reduce AGI depending on how you file your taxes for the entity that the plan is attached to. Chelsea, so we'll get into that in a moment with Roth 401ks. The short answer is yes, but it ultimately depends on how you are filing the taxes for yourself personally, on whether or not you are taking deductions for the contributions that are being added into these plans. The plans that we offer do inherently allow for there to be a Roth 401k contributions accepted, but you have to then in turn make sure that you are correctly filing your taxes to show whether or not that the contribution is either deductible or non-deductible, and that if you are making an employer match, if you are converting that, then also claiming that as additional adjusted gross income for that given year to make sure that you are showing that the plan is non-deductible and taxes have been paid on those contributions. So just a little bit of contribution comparison to show kind of how powerful these plans are, just with an individual that is a sole proprietor making $100,000. So John made $100,000 in 2020. So let's kind of show exactly, how much money he could potentially put into these, and then also, how much of a deduction that he can then in turn create. So he's showing $100,000 of total income, which is going to be taxable to him directly. So with a simple IRA, he can contribute $13,500 of his salary and then match by the employer. Again, this is loosely termed employer because you are the self-employed individual, adding an additional $3,000 of that $100,000 into a simple IRA. So you get up to $16,500 of deductible contributions being made in a simple. With a SEP IRA, it's just a straight 25% of your total compensation can be contributed to that plan. So you can contribute 25 grand to a SEP IRA and then in turn deduct that 25,000 off that 100. So you'd have $75,000 of taxable income showing for that year. Now with a solo 401k, you get a significantly higher amount because you have two different portions of calculations that you're using to make these contributions work. So John in this instance can contribute $19,500 of his salary, assuming that he's under the age of 50, because there are catch-up contributions for those over the age of 50. He can right away contribute $19,500 of that $100,000 to the plan. Now he can either take a deduction for that and create a traditional tax-deferred 401k plan, or if he doesn't want to take a deduction, he can then in turn, create it as a Roth 401k. And you can commingle these funds within the plan. You don't necessarily have to bifurcate the different pools of funds. You can do net earnings attributable to the different pools of basis within the plan. But again, if you're going to be doing a do your own model, you're going to need to really be careful. And I would highly recommend involving a CPA or a bookkeeper to make sure that those types of calculations are done correctly. But getting back to his 401k contribution, he has $19,500, which he can directly contribute to the plan. Now, because he is paying that all directly to him as a pass-through on that $100,000, he can also contribute 25% of that total 100,000 to the plan as well. So he has an additional 25 grand that he can match as the employer. Again, he's self-employed to that plan. So in total, if he's under the age of 55 and a half, he can contribute $44,500 to that plan on an annual basis. Now, let's say that he is over the age of 50 and a half. He can contribute another $6,500 of deferral into that plan under the salary deferral portion, bringing him totally up to $51,000. So he can cut, if he wants to make this all deductible contributions, he can cut his adjusted gross income for that year. He can cut it in half with a solo 401k, not including any other deductions that he might have. But the nice thing about this is that he is getting to keep all of this money, and then also creating a pool of funds that are going to grow completely tax-free or tax-deferred, depending on how he wanted to take his deductions. So it's really powerful to look when you're looking at a solo 401k versus SEP IRA versus simple IRA. One, in just the amount of money that you can reduce being shown as earned income for a given year, but also in the flexibility of customizing those contributions and assets. With simple IRAs and SEP IRAs, they both are custodial type accounts, meaning that you have to have a custodian involved. You can't self-administer these types of plans. It is codified like that with the Internal Revenue Code. With a 401k, it is a trustee-driven plan, and the business owner can act as the trustee of that plan, meaning that you, as the self-employed individual, can self-administer if you want to, in a do-your-own fashion, self-administer your own 401k. So it offers not only a significantly higher degree of contribution and flexibility of your contributions, it also offers a much greater degree of flexibility with administration of the plan. Let's see. Okay, Larry asked, if you have self-employment income, but taxable income is zero due to net operating loss carry forward or other business losses, such as rentals, can a deductible contribution be made to a 401k plan? So it brings up an interesting aspect. So if you are going to be showing zero income because of carry forward loss or other large deductions you get to take from your business that pass on to you, and you are going to show zero income for that year, depending on how much that you're carrying forward in deductions, that's when you would really want to look at making these as non-deductible contributions. Because if you've already wiped out the amount of income being shown, then the need to do it as deductible contributions is significantly reduced or eliminated. So at that point, I would really encourage people to look at making it as a Roth contribution, making sure that you're still keeping in line with your tax planning strategies, which again, you need to check with a tax advisor on. But at that point, being able to utilize the aspect of the 401k, which allows for after-tax contributions, can be really powerful. Unlike the SEP and Simple, which are always going to create deductible contributions, which don't carry forward, so you might just have a lost deduction on that year if your carry forward losses are eliminating your income being shown that year. Being able to make a non-deductible contribution to a 401k might be a real powerful tool in that scenario. And again, you need to check with the tax advisor on whether or not that would kind of be the best course of action. But at least in my mind, in that scenario, the non-deductible portion of 401ks would be a really interesting thing to look at in that particular case. I do see someone has their hand raised. Again, please make sure that you type in your questions if you do have them. Thank you. All right, let's keep moving. Okay, so investment options. Not going to spend a whole lot of time on here. I'd just like to make sure, at least for the slide deck, that it is included. With these types of 401k accounts, there isn't really any type of restriction on the investments that you do, past just making sure that you follow the general guidelines set forth by the Internal Revenue Service and the Department of Labor of whom you can't directly deal with, and some real specific types of investments that you can't invest in. So you can certainly invest in the wide range of open market securities. You can also invest in things like we specialize here in allowing for clients to do, things like real estate, notes and mortgages, private placements, futures, private LLCs, and the like. Let's see, we got a question. Okay, actually, before we get into this, I think we have a good question that might help some people. So I maxed out on my 401k at work at $25,500. I have a few LLCs and S corps that generate income. So can I put 25% of the net operating income into SEP IRAs from each LLC and S corps as long as the total from the SEP IRAs is less than the total? So with regard to that, you do have the potential to open up multiple retirement plans. However, with the differences being between SEP IRAs and solo 401ks, it's really going to be kind of boiling down to personal preference. So you are able to be covered by the SEP IRAs because those are business contributions. Your 25.5 being your elective deferral into that 401k plan, you are able to participate in multiple 401ks as well. So depending on how you wanted to treat the income at the end of the day, if you had other entities, you might be able to set up a 401k either individually or just as a controlled or affiliated service group, which again, I would really recommend you talk to a tax advisor on or someone that can advise you, because you do have the ability to also contribute portions, the 25% of the net operating income from those businesses. And with the 401k specifically, depending on whether or not you need the deductions, you can do in-plan Roth conversions of that in order to make all of those Roth going forward. So depending on your need for a deduction is really going to kind of drive which plan you choose in that scenario. The SEP IRAs are going to offer a little bit less in the way of flexibility for administration, and they don't offer a Roth portion, but you can do 401k and potentially maybe kind of streamline your administrative process by being part of a controlled or affiliated service group and using one plan to cover multiple businesses. So good question, but it's definitely something that needs a little bit further diving into from maybe a qualified tax advisory professional. So we kind of covered what you can invest in, but what you can't. So it's really brief. Just want to cover and make sure people understand a few of these items that you need to look out for. Prohibited investments. You can't buy a life insurance policy with 401k plans. You can't buy anything that's a collectible, so antiques, rare bottles of wine, artwork, stamps. You can buy gold and silver and bullion. So there are certain types of coins that you can invest in, but they have to be traded on their bullion content value. You're not trading them on like the rarity of the actual item. So there are some prohibited transactions. You can't trade or do business between prohibited individuals. The next slide covers who those individuals are. And then some other things to be aware of, although most people, and I'm assuming that some people on here are probably familiar with UBIT and UDFI, the 401ks do exempt you from debt finance income tax on the acquisition of new real estate. But if you are going to be looking to acquire businesses that are outside the scope of having buying shares of a C Corp, you still may expose these plans to UBIT. So keep in mind that the exemption is not in totality. There are some aspects of UBIT and UDFI exemptions that can still pass through to 401k plans, although not nearly to the extent that they do for IRAs. So here's the individuals that are disqualified from directly dealing with your 401k plan. And it's especially important to understand this if you're doing it yourself without direct involvement from Advanta. It's the 401k's owner and spouse. You can't sell something you personally own to your 401k plan, and any lineal descendants or ascendants of you personally, so anyone directly up and down from you in this tree right here, you can't directly buy or sell anything to them. And I do understand the infographics of the IRA holder. I couldn't change that. It needs to be 401k, but I'm assuming everyone kind of grasped the concept. I got a question. Okay, so we have a question. Will UBIT apply if one invests in a real estate syndication? So typically no, so long as that the liability that would be generated to an IRA is determined to be based from debt financing. So long as that liability was generated by the syndication having debt, then yes, a 401k can exempt you from that type of liability. Now, if that syndication was operating a trade or business, so if the UBIT liability was deemed to be generated outside of the scope of the debt on the property and was from a trade or business, then not necessarily. That typically doesn't happen. Typically, the syndication will strictly be for the ownership and the acquisition of financing, and then the other things like property maintenance or other types of entities would be held outside of that for that exact reason. But I like to kind of give a more comprehensive answer to that, just because the answer isn't as clear and well defined as some people might make it out to seem. So long as that the liability that you're looking at the exemption for is generated by the debt on the property that would cause a UBIT liability for an IRA, then the 401k would help exempt you from that. Would exempt you from that if investing into a multifamily or any type of real estate limited partner syndication. Okay, so now we're going to get in kind of, the main purpose of why I wanted to bring this up to people today is that there's really kind of two different ways to look at 401k plans. You can either do a more full service model where you involve, obviously using Advanta in this scenario, using Advanta for cash management service and record keeping of assets and expenses and the like. Obviously, that is, a more expensive option, not by, a order of magnitude, but there is some expense to be considered in there because we are providing a service. But depending on how comfortable you are with doing your own bookkeeping, because remember, you are acting as the trustee of the plan. You are signing any documents, you are doing all the tax reporting. So essentially, in the case of doing a more full service, you are paying us for record keeping. Now, at the moment, we are still building out. Hopefully, by the end of this, and by the end of the year 2020, we will be able to offer Form 5500 reporting and 1099 reporting for our more full service clients. But presently, it is a more of a bookkeeping relationship that we have with the more full service option that we offer. So it's definitely a little bit easier for people that are just getting into 401ks to have us do the bookkeeping, do the cash management. It will certainly kind of streamline the process to where you don't kind of have to learn as much on the front end, but there is a little bit more involvement with Advanta with having to contact us to get checks written, to have expenses paid. We do issue those within 24 hours of receipt, but keep in mind that there's a little bit more that goes into that. And we can also record keep contributions as either being Roth or traditional, employee versus employer. We can do that type of record keeping for you if you're not used to doing that on your own. But most self-employed business owners are a little bit more familiar with that than the general public. So it's a good thing to look at all of your options with regards to how these plans are administered. Now, for a do your own or a DYO plan, you have much more flexibility in the accounting of the plan, meaning that you can use your own accounting principles, you can use your own software, you have full access to the bank account, you are doing all of the administration of the plan minus the plan document, the 401k plan document and adoption agreement services, which is what you're engaging us for. That's the one part of the 401k plan that you cannot provide yourself is a 401k plan 401k plan document and adoption agreement are the two items that you need provided by a third party. So in a do your own 401k, it's more of a rental engagement with us where we provide the backbone of the 401k and then you build off from there by doing all of your own accounting for the plan. Obviously, that drives down your administrative costs because you are doing that. So just keep that in mind. That's kind of the big reason that a lot of people choose the do your own model. And the do your own model inherently comes with checkbook control. A lot of people, when looking at IRAs, want to look at the options for checkbook control where you utilize an LLC underneath of an IRA. Well, this is one way with the do your own plan to automatically generate a checkbook control model without having to set up another LLC. So the plan itself can automatically from the start have checkbook control directly built in. Let's see, Robert asks, so IRA holders IRA 401k holders, the brothers and sisters and nieces and nephews are allowed to directly transact with each other. That is correct. It is kind of strange that the IRS deems everyone else to be prohibited, but someone as closely related as a brother or sister or niece and nephew, or even in-laws to some extent, and aunts and uncles and things like that, are allowed to be invested with directly, meaning that you could actually buy an asset owned by your brother. So if your brother or sister owned a rental property and you wanted your 401k plan to purchase it, the 401k plan could directly purchase it. Now, keep in mind that I would highly recommend, if you do deal with any of these individuals kind of in your more nuclear family, if you will, that you make sure that everything is done on a fair market value basis. Although the penalties for prohibited transactions are significantly less impactful with a 401k than an IRA, and actually explain that here in a moment, it is important to make sure that you don't still run afoul of that because it can be very expensive. If you were to commit a prohibited transaction and it were to be found out by the course of an audit by the IRS, the penalty for an IRA is that the whole IRA plan is deemed distributable as of January 1, in which the transaction occurred. They go back 7 years. So you'd have to refile all of your tax filings for, at a maximum of 7 years. You would pay a 10% excise tax, or no, 15% excise tax, prohibited transaction penalty, plus any applicable income taxes on anything distributed. Now with a 401k, if you are deemed to have a prohibited transaction, it does not blow up the plan. It is a 10% penalty per year till the transaction is corrected. So if you bought a $100,000 property that was deemed to be a prohibited transaction and you corrected it the following year, it would be a $10,000 penalty and the plan would still remain in existence. So although there's certainly not as much of a nuclear penalty with a 401k, I would highly recommend that you follow the rules, because the last thing you want to do is cost yourself money and within a plan that is so hard, that it has so many steps to get through just to put money into it in the first place. So I know that was a little bit maybe more involved than the question you asked, Robert, but I think it's good information nonetheless for people to have. All right. So with a solo 401k or a do your own plan, you really need to be cognizant of the fact that these plans are designed specifically for self-employed individuals, for spouses, and for businesses that are all owner operated, meaning that you don't have anyone that is what is considered a rank and file employee or a non-equitable owner employee. Once you get past that, then you have issues with having to have more of a compliant 401k plan, what is called safe harbor 401k plans. The administrative costs get significantly higher with that. So if you're a self-employed individual and you're looking to hire people, or maybe you have someone that works for you, you really need to make sure that, before you start a 401k plan, that you really make sure that their employment isn't going to kind of drive you into a much higher cost type of plan that you need to have, because we don't provide those types of plans. They have a lot more that goes into the administration of them. They have things that are called plan testing, where every year you have to have third-party audits to make sure that the plan is being fairly offered, discrimination testing to make sure that all employees that are eligible to be participating in are notified in accordance with Department of Labor laws. It's kind of a big to do. So the plans that we're talking about here are for, again, owner-operators, self-employed individuals, for their spouse, or with a business that is only operated by equitable owners of the business. And there's no ratio to that. So long as that all of the quote employees of that business are owners in any percentage, that can still qualify under a solo 401k plan. I had a solo 401k plan that was used for a business that had 5 partners in it. It still qualified to say we're all equitable owners. But if it was, 1 partner and then 4 employees, then the plan couldn't have been used. So a little bit of information on the basis of impact of having other employees. You can exclude some people from a 401k plan, which would still allow you to use certain types of plans. So individuals under 21 someone that's a non-resident alien, and then people covered under union employment contracts or collective bargaining agreements can be excluded. What type of employees must be included? Now, this type of metric just changed. So previously, you had a little bit more leeway in exclusion of people that worked for you, especially if maybe they were seasonal um, and the like. But now, with the passage of the Secure Act, which was the large piece of legislation passed under the Trump administration for tax reform, it brought in a new metric of changing what exactly an employee meant for the purposes of retirement plan offerings. So if you have an employee that works at least 1,000 hours per year, or at least 500 hours over 3 consecutive years over a 5-year period, they have to be included in the offerings for 401k plan. Now, let's say that you've already done solo 401k and you're getting more, and you're going to be kind of moving that into a more compliant safe harbor plan. If you have a DYO plan, it's definitely a little bit easier to move that into that type of plan administration for a safe harbor plan. If you are doing a more full service model, although it's still certainly available to you to move into a bigger, more compliant plan, there's going to be a little bit more overhead costs for porting all of the transactional information to another third party administrator for that plan. See, Sam asks, can you roll over and merge the earlier 401k when you were an employee into a solo 401k? Yeah, I'm assuming that you are referring to the fact of like a 401k that you had of an old employer where you were maybe like a 9-to-5 or a W-2 employee. You can certainly roll those funds directly into a new solo 401k that you've established for yourself as a self-employed individual. So any type of old retirement plan, so long as that it's not a Roth IRA, although you can have a Roth 401k, can be rolled into a solo 401k. So any of your old deductible basis plans, whether that was something like thrift savings plan, a governmental 457, an old 401k, a 403b, a traditional IRA, SEP IRA, simple IRA, all of those types of plans can be rolled into a solo 401k that you set up for yourself. All right. So what are really the primary differences between this? So in this case, how much control does John want, going back to our scenario of him contributing into this plan? So cash and assets can be administered by Advanta IRA as a third-party administrator, or directly as John as the trustee of his plan. Now, keep in mind when you think about things like IRAs, how you always have them held at a custodian like Charles Schwab or Advanta or someone. All of the assets are kind of held separate from you and your own direct account. You don't necessarily have direct access to that. Everything is titled kind of separately from you. Now, everything does need to be titled in the plan, but in both scenarios, it's going to be John Smith as trustee of the ABC 401k plan. And then if he has a do your own model, all of the cash and everything is going to be directly held at a trust account that he sets up at a local bank to him. He is going to do all of the bookkeeping for that plan, of any contributions, of any income, of any expenses paid out of that plan, as well as any distributions of that plan as well, is all going to be taken care of by John and the do your own model. Now, if he was using Advanta as more of a bookkeeper and record keeper of that, he wouldn't hold the cash account. It would be more into the model that you're kind of used to with IRAs. So it's important to understand that just how much control you're taking with a do your own plan. So not only are you taking care of all of the cash, so when you call Advanta, all that we're going to show is that you have a rental relationship for us for a 401k account. There's going to be no cash account here. There's going to be no record kept assets here. It is simply going to be strictly just a record of the fact that you have a rental relationship with us. Nothing is going to show on our books. You are going to be solely responsible for everything going into that. Now, if he were to use us in this scenario for doing more of the full service model, he would need to contact us for any checks that need to be written, he would need to contact us with regards to releasing funds for the closing of a new investment. And then any income from a third-party model for doing it with Advanta directly as more of a full service, all of the income would come directly to us as well. Now, with a do your own model, all of that is going to be coming back directly into the account that he administers directly himself. So he has more direct access to the funds for investing. He has literally a checkbook for that trust account that he's opened up for the 401k plan. He has the ability to invest into more opportunities with less administrative costs, because remember, in this scenario, he is taking care of all of the bookkeeping. So he gets to write a check for any investment. He gets to, he could even open up a brokerage account with a securities broker if you wanted to have securities under this plan, as well as alternatives like real estate, which is a really big benefit. So that way you don't have to have, as many different things going on. You can kind of have this one centrally located plan that administers a multitude of different assets. Now, he can probably, the ability of him to track pre and post tax contributions with having direct access to the accounts is also going to be much easier, because you're going to get to employ your own tax accounting software. You're not going to be locked into Advanta's method of accounting, although it's very clear what we're doing. If you have something that you want to use that makes it more clear for you, you have the option to do that with a do your own 401k. You also have access to tax-free loans from the 401k, which aren't going to drive your administrative costs up of the 401k like they would here at Advanta. If you have a debt leveraged real estate investment, again, you get the same exemption that you do in a more full service 401k. And then also you have, again, that much more cost effective administration of the plan. But keep in mind, with all of these advantages, you do have all the responsibility placed on you as the trustee to take care of all of the plan reporting things. So like if you have to do Form 5500 for the 401k plan, if you have to do 1099 reporting for distributions, if you need to do correct payroll deferral reporting for yourself personally on contributions to the plan, that's all your responsibility. But if you're a self-employed individual, the likelihood that you probably have a CPA or tax advisor is probably significantly better than most other people in the world. So I would recommend contact your advisor, tax advisor, contact your CPA, see if they offer bookkeeping services that they can add on to what you're already paying them, which you can probably get at a discount if you're using the same person, to help you drive a much more effective route of your 401k and tax planning strategy going forward. Now, just a quick slide I wanted to put up. I know we had some questions regarding debt leverage and UDFI. Again, remember, if you are going to be utilizing debt to acquire any assets under any type of 401k plan, you are going to potentially be subject to UBIT. Now, if that non-recourse financing is used to acquire real estate, no taxable liability, don't need to worry about it. Again, if you're doing this as a DYO model, you don't have to worry about paying Advanta for another record-keeping liability within the account. You do get the ability to handle that personally, although, again, it's a comfortability factor. We're very familiar with how to record keep these, making sure that everything is book kept correctly. But keep in mind that is an option. If you're going to use debt, it has to be non-recourse, meaning that in the event of default, the lender can't come after the trustee of the plan personally or anything other than just the plan asset that was used as collateral. And then again, remember, even though you do have slightly different rules between IRAs and 401ks, you as the trustee cannot levy a personal guarantee towards the repayment of that loan for the 401k plan. And then again, this one is more just a confirmation slide for anyone that maybe isn't listening and just wants to use the slide deck. Again, remember, IRAs, if you finance and you have some sort of finance deal, whether that is a limited partnership, syndicated deal that the plan is involved in, the IRA plan, excuse me, or direct acquisition utilizing non-recourse debt, it is going to be taxable to the IRA. 401k accounts have the huge benefit of not having to pay those taxes at all. They're completely exempt from the acquisition of new real estate with non-recourse financing being utilized. So with that said, that's pretty much it. If you have any questions, I'm here to answer them. I normally end this up done a little bit early. Normally run these till about 1, but I'll keep it open until there's still people here. If you would like the recording of this, please go to our video library. It will probably be up tomorrow. Or if you would like a copy of the slides, please feel free to email me, or if you have any questions, feel free to email or call me directly. I am happy to send any of that kind of stuff out. I do greatly appreciate everyone being a part of this presentation today. Hope you found something useful that might help you on in the future with regards to how you're utilizing your 401ks or tax planning strategies as a self-employed individual. So thank you very much, and I hope everyone has a great rest of their day. I will stick around here till there's probably about 10 people. Right now we have about 30 on the call. Okay, what is the process of converting funds already in a solo 401k into a Roth? Now, if you are looking to convert in plan, you would need to file IRS Form 1099-R to yourself, showing that a amount of money was, or amount of income was received, and then properly account for that when filing your 1040. So you would need to file 1099 with a known exception to yourself, and then make sure that when you get with your tax, or your, either you as the trustee or your tax advisor that's helping you with these filings, we need to make sure that 1, 1099 is correctly reported, and then 2, that is correctly accounted for as additional income for the participant of that plan in that given year. You can certainly do an in-plan conversion. It's just a matter of doing the correct 1040 and then the 1099 reporting. Yes, so that income would be reflected in your adjusted gross income for that year. Just as if we're doing an IRA conversion, so converting from a traditional to a Roth, it would just be a straight adjustment up of your AGI for whatever the amount of conversion is. And keep in mind, there's no penalty for that. So no matter what your age is, there isn't a penalty for doing the conversion because you're not taking the money out even if you're under 59 and a half. So there's no early withdrawal penalty. It's just a straight line item adjustment of the AGI for that year. Let's see. Solo 401ks can take out loans to buy assets. Yes, Robert, they can. They have to be non-recourse, meaning that the trustee cannot levy a personal guarantee and that the lender agrees if there is security offered, they can only come after the underlying collateral. They can't come after other plan assets or the trustee personally for repayment of that. They have to be made whole by the underlying asset. Larry asks, for non-deductible contribution to a 401k or IRA, how is it reported on a tax return? To be sure it is considered as having basis as the contribution. Excuse me. That is done as a part of your 1040 when you're actually doing it. I don't know the actual subsection of your 1040 filing, but when you do that, you are confirming that you have made a contribution and whether or not it is deductible on your 1040. Now, that can, depending on how you're actually reporting it as the employee or the employer, that also is a box, and it can be codified on the W-2 if you pay yourself out on Form W-2. But depending on how you actually report the payment to yourself as a self-employed individual, is going to kind of determine where you indicate that. So that can be reported on Form W-2, which in turn flows into your 1040, but you would need to get with your tax preparer to figure out exactly the way to show that for you. But essentially, it's done on your personal income tax report, however that may be reported for that given year. Let's see. Can you use a thrift savings plan and convert to a Roth 401k? So thrift savings plans are kind of interesting. So for those that are familiar, the thrift savings plan is the retirement plan that is offered to the Department of Defense and the Armed Services for retirement plan for anyone that is an employee or a active duty military. So with that said, thrift savings plans do have a non-deductible provision of it. Now, depending on how money got in there, you can either make non-deductible contributions, or certain imminent hazard pay for deployed armed forces can be considered Roth in those plans as well. Now, those types of, like, if you have non-deductible basis in that plan, it can go directly to a Roth 401k. That's not a problem. The issue is that if you have deductible basis contributions, which is the majority of the contributions to the TSP, you can roll that out of that plan and then roll it into a 401k and then convert it. There isn't kind of a way to do it like in the air, if you will. You would need to put it in the plan and then convert it. But yes, you essentially can arrive at the destination you're looking at. It just might be kind of an odd route, but there's no inherent issue with doing that. Let's see. Can a solo 401k plan get a loan from a brother to buy assets? Yeah, it's not a problem so long as that it's not, like a 0% interest loan and it's done, at whatever a normal private loan market rate would be and it's non-recourse. Yeah, you could do that. Now, keep in mind that your exemption from debt finance income tax is only if you're buying real estate. It wouldn't necessarily apply to other asset classes. So if you're looking to buy a piece of real estate with financing, your brother could finance it for the 401k, still needs to be non-recourse, and the asset class is going to determine your exemption from UDFIT, which is the subset of UBIT taxes that you're really looking to avoid. So keep that in mind. That's something important. You can do that. And then Sam, yeah, I mean, you can definitely use all those funds to buy real estate within the plan. Whether or not you do it as a do your own or a full service model, the asset classes that can be pursued aren't going to be restricted. Whether it's Roth 401k money or traditional 401k money, you can still pursue real estate or really whatever else you'd like to. With that said, again, everyone, I hope you have a safe and wonderful rest of your week. Thank you for joining us today and hope to see you on one of our great upcoming webinars. Please check out advantaira.com/events for all of our great educational events that, of course, are always free. Thanks. Have a wonderful day.